Hey traders! Today I want to get into the infamous Fibonacci levels, where to use them and how to draw them. Welcome to today's video, Fibonacci for Beginners, the only guide you need. I am also going to be creating a forex trend continuation strategy video this week using Fibonacci levels as the main indicator, so make sure you hit that subscribe button so you are notified of that video. Alright, let's get into it. So the levels were created by a famous Italian mathematician called Leonardo Fibonacci. And before you switch off the video because you think I'm going to go in depth into how the numbers are worked out, etc., don't worry. It is not necessary for you to know the ins and outs of this to use the indicator successfully in trading. The first thing you need to know about Fibonacci levels is that they work best when the market is trending. That is, it's either in an up or a downtrend. Now, I'm not going to go into how to ascertain whether a market is trending here because I have already created a video on how to identify trends, which will be popping up in the top right of your screen. Click on that and watch it first if you don't know how to identify a trend in a forex pair. Because this indicator is used mostly in trending markets, when drawn, the Fibonacci levels act as support and resistance levels, and traders use them as potential points to enter long in a bullish trend or short in a bearish trend. In a bullish or bearish trend, after the market has made a large upward or downward move respectively, there is a high chance the market will then move for a period of time in the opposite direction. This is known as a retracement. It is when this retracement is happening that the Fibonacci indicator can be drawn onto your charts. In an uptrend, the Fibonacci indicator is drawn from the most recent higher low to the most recent higher high. Conversely, in a downtrend, the Fibonacci indicator is drawn from the most recent lower high to the most recent lower low. The levels that then appear when you do this pinpoint areas that could act as support or resistance levels for price, and at these points, traders will look to enter the trade. The main levels you need to know about are 23.6%, 38.2%, 61.8%, and 76.4%. There's also the 50% level on a lot of charting software. Although this is not an official Fibonacci number, it is widely recognized as an important reversal level, and for this reason becomes a self-fulfilling point as so many traders are eyeing these same levels. Let's jump over to some charts to see how we would draw the levels in practice. Okay, so here we have a daily chart of the euro versus the US dollar. As we can see, the market has started to continue its downtrend after breaking through this support level with a strong bearish candle. It then started to retrace. At this point, we could have drawn on our Fibonacci indicator just like this. Remember, it is a downtrend, so we start at the most recent lower high. We then drag down to the most recent lower low. As you can see, the Fibonacci levels automatically appear on the charting software. Finally, on this software, we drag across so that the levels are clearer across the entire screen. What we can see here is that price retraced right back up to that 50% Fibonacci level, where it stalled for about 6 days before duly turning bearish. What is also interesting to note here, and the reason it is worth dragging the Fibonacci indicator across the chart, is that the market tends to stick to those levels. Here we can see the market retraced and formed a double top right at the 38.2% Fibonacci level. If you are not familiar with double top and double bottom chart patterns, click on the link in the video description below this video to learn in depth what they are and how to use them. Here we can see that the market started to trend sideways, but the 50% Fibonacci level once again acted as an area of resistance here before the market started again trending lower. Now here is a daily time frame of the Australian dollar and the US dollar. By the way guys, you can use this method on any time frame. It just so happens I do the majority of my trading on the daily time frames, which is why I'm using this as an example. We can see that price had hit that descending trend line for a second time with lower highs and lower lows. A new lower low had then formed and price had then started to retrace. Once again, we draw the Fibonacci indicator starting from the most recent lower high to the most recent lower low. We can see that the price stalled right around that 61.8% Fibonacci level, twice bouncing off this area to form a double top. Here we could have entered the trade short, and as you can see, price once again turned bearish. Once again, extending the Fibonacci tool right across the screen, we can see that there was a second trading opportunity when price formed another lower low and then retraced right up to that descending trend line once more and bang onto the 38.2% Fibonacci level. Okay, now for the uptrend. This is a daily chart of the US dollar against the Swiss franc. We can see the pair was in a broad uptrend, having bounced off the ascending trend line twice and forming higher highs and higher lows. It then began to retrace back down to that trend line. Price came right back down to the trend line and this time bounced right off the 76.4% Fibonacci retracement level and formed what's known as an inverse head and shoulders pattern. And it was at this point that we could have entered a long trade. I haven't done a video on major reversal patterns and how to use them yet, but if this is something you would like to see, just let me know in a comment below. The price then continued to push upwards with bullish momentum. Lastly, here is a weekly chart of the euro versus the Canadian dollar. As you can see, the price has bounced off the ascending trend line twice, forming higher highs and higher lows. It had formed a new higher high and was retracing. Let's add the Fibonacci indicator from the most recent higher low to the most recent higher high. We can see that price bounced right off the 76.4% level with a well-formed double bottom and continued its bullish momentum. If we had entered long after the double bottom formation, we would have gained some major pips. So there we have it, guys. That is the basis of the Fibonacci indicator and how to draw it correctly. The Fibonacci indicator is a fantastic tool for beginners because it's easy to grasp and use straight away. However, it should be used in conjunction with a main strategy. That's why I have put together a 100% free ebook for you called the 3-Step Trading System, which details the basic strategy that I started out with to trade successfully in the markets. Simply go to www.theposhenglishtrader.com/3steps to download that now completely free. Once again, simply type into your browser address bar theposhenglishtrader.com/3steps or simply click on the link in the video description below. To be notified of my next video on how I utilize the Fibonacci retracement as part of my trading strategy, make sure you hit that subscribe button and hit like to let me know what you thought of the video. Okay guys, until next time.